Morning, Shane.
G'day, Chris. How are you today?
I'm well, thank you, mate. I'm well.
Here we are, May.
Yeah, I know, it's happening, isn't it? Very, very quickly.
Well, I sort of feel like I'm pleased we're doing it together again this month, because last month we spoke about April and the depth of Iran and conflict, and here we are a month later, and there's still lots of things playing out.
Yeah, well, there's a lot going on, isn't there? It's and it feels, it feels like there's almost more, I suppose, happening in the world than maybe there was a month ago. I guess particularly around AI, which we'll sort of get into. So it's definitely not a quiet month, that's for sure.
I think a little recap for the month that was. We've seen ceasefire hold.
Yep.
Seemingly hold, and then perhaps not hold again.
Yep.
But we saw a few missiles being fired a couple of days ago. But ceasefire has held by and large. Inflation in Australia, it's out of the bag once again. Reaccelerated, and obviously a rate rise yesterday.
Yep.
I think one of the biggest shifts, though, Chris, has been business confidence has been soft.
Yeah, I think I also wonder whether this will, at least anecdotally to clients that I talk to, whether this is going to start flowing into consumer confidence as well. I just don't feel like there's a huge amount of positivity with interest rate rises going up. Cost of living continues to increase. We've obviously had the conflict in Iran, which everyone's sort of worried about how that's going to flow through, because that's what the media is saying. Portfolios, I know we'll get to this, but I guess have been something on the down during that conflict period. There's probably not a lot for people really to sit out there and go, well, things are going okay. And then you've got AI out there, like, I guess, putting people's jobs at risk. Then there's not a whole lot to really be bullish about.
Yeah, it's a very interesting time in history, and like you say, rates are higher. They're going to be longer up for now. Sufficiently restrictive, or restrictive was a phrase yesterday from Governor Bullock. And I guess, thinking about on all that reflection, how do we respond through that month?
Yep.
We essentially stayed the course, right?
Yep.
Like you can easily panic in times like now, I think is the
very easily. And I think that's the discipline aspect, right? So again, we'll get into that in terms of why we have acted the way we have and what's the evidence behind it. But trying not to, I guess that sort of behavioural coaching of trying to not act on your emotions is probably the most important thing you can do right now.
Totally agree. And excuse my voice there. Let's look at Iran, Chris, shall we? The headline we've got here on our slide deck is from shock to relief rally, and it has been that way, right? It really has. April was a terrible month, and it was, we sort of saw maybe negative 13 from top to bottom, but through a month it was about negative 8. I think in April we're talking about this time, 4 weeks ago, and here we are. Markets are back to where they were, and it's hard to kind of pick it apart, I think.
Yeah, definitely. Look, again, this speaks to there's a number of, I guess, areas that are happening through the economy. Lots of like markets generally, there's lots of intersecting forces. But I tend to agree with you, as I know we talked about this last time in terms of the average return after conflict was like 56 days. For it to be a month is quite extraordinary, really. It's sort of unusual.
Yeah, and I think reflecting on last month, we shared a slide around the likely scenarios, base case, the sort of material disruption that followed. And I feel as though we're kind of on the edge now of kind of that, the most likely being our base case was that we have, sort of short-term military action.
Yep.
The Strait reopens reasonably quickly. Oil price doesn't stay elevated for an extended period of time. But it feels like we're just bleeding a little bit into that sort of more material disruption, phase. Whether it reverses or not shortly, you don't know.
Yeah. Yep.
I think Iran have seemingly figured out how to disrupt the world pretty comfortably, and perhaps I'd like to say caught the Americans off guard, but I don't know whether that's true or not.
Yeah, I'm not sure. Off guard. Yeah, well, maybe probably just exposed a lack of understanding of preparedness, I suppose. Yeah.
Yeah, and it seems like Iran are digging in here, right? Like, I mean, it's really tricky to see where it lands, but. I watch closely with sort of diplomacy and whether or not we can actually see this ceasefire hold. And, I feel as though both sides are probably, as, sort of stubborn as each other at this point in time, which makes it very difficult to get a resolution.
Well, it does. I guess if you think like at the Iran situation, like it's an existential crisis for them essentially around, you know, what do they if they fold, then, you know, from a regime perspective, that's kind of it, sort of. So you know, in the US, well, who knows if they're going to save face or not. I'm not sure that there's any face to save, to be honest. But
Well, as we joked last month, and maybe joke / not joke, but no matter what happens, I'm certain there'll be a headline where Trump announces they won the war or won the conflict.
yeah,
I think that's the only thing that's guaranteed in this whole process is that there's victory claimed.
I'm pretty sure he has already a couple of
Probably
times.
right,
But anyway, so
There's a definition of victory is to be tested, I think. But yeah, it is a tricky spot to navigate, and I feel as though we can't do too much other than be sort of at the mercy of it.
Well, no, we can't really. But and what we're seeing in terms of it flowing through into higher inflation, or higher for longer, I guess we are all going to bear the brunt of that. It's just being able to manage that, and I suppose one of the good things, good in a bad context, is that, you know, we have been through this higher inflation world relatively recently. So coming out of COVID and having the expansion of inflation during 2023, I think understanding, you know, what has happened, and the central, at least here in Australia, trying to get ahead of it in some ways, as much as that's painful for people. You know, maybe they can see that there's a rationale for why they're approaching this the way they have.
And I find it really fascinating, this inflationary debate, right? Because, you know, the one side of the coin today is that the conflict in Iran is causing the inflation spike, but inflation was already elevated before Iran took place. The read this month was very bad from an inflationary perspective, and we haven't really seen the full flow through from elevated oil price and what it's doing to inflation just yet. So I shudder to think at what it may look like in 2, 3, 4, 5 months from the inflationary read.
Yeah, well, I guess, and this is probably coming to some of the other points that we're talking about in terms of like AI specifically. What sort of impact that's potentially going to have? Like, it's, as we will walk through, it's had some impact on markets and what's happened over the last month. But then I think about the aspect of that in terms of like potential job losses, and then what that does for unemployment, and then demand in that respect. Like, maybe we have an offsetting force that may possibly be worse than oil prices going up.
Well, I think there's a chart. I've just jumped forward on our slide deck here because I think it's a good segue into it. There's one of the things, you know, for our listeners that we've been discussing in our investment committee is around there's a part of you know, rationale that's hard to figure out now, in that the markets have rebounded back through April. So the initial shock and then relief rally that's followed has now got us in a position where a lot of the conflict has not been. It's still there. The oil price is still high. Inflation's pushing up, but yet our share markets have gone back to where they were. And it's like, in my maybe very logical brain, it doesn't compute in some respects. And there's a very good chart that we've got here about productivity gains from AI, and it speaks specifically to, you know, really the Nasdaq in the US, and, you know, the sort of the Magnificent Seven in terms of how much money they're making, or how much pricing has been put into those share prices around productivity gains from AI. How do you say that, mate? I guess that's an interesting. You know, that's a big piece, but worthy of just spending a minute or two on it.
Yeah, well, it really is, and I think it's probably just an extrapolation of what has been happening over the last couple of years. In terms of, there was a little bit of worry for a while there, early this year or late last year, around the capex spending in AI, and now that seems to be well and truly past. I think because the rollout of that has probably come down into, at least here in Australia, because I know I've talked about this with you off camera, is that, you know, we haven't seen any of that really in Australia until maybe, you know, even the last month or two. At least anecdotally, talking to people who are working in corporate jobs in terms of the actual rollout of some of AI's capability. You know, seeing that in the share prices of the Magnificent Seven, if I think about that, I'm like, well, then I would expect, and I know you're probably closer to this in terms of what's been happening in the US, is that those tools are then rolling out into the other sort of 493 companies, and you might expect productivity gains, which usually would then translate into increased margin, and then profitability reported to the market, and then you would expect markets to increase, I suppose.
Well, you look at this chart here, and it tells the exact story, Chris, right? Doesn't it?
Yeah.
Like in Australia, equity market returns, ASX 200 over the last 12 months, 6.8. S&P 500, 22.4, same time frame. And obviously the dragger in the S&P 500 is the NASDAQ, which has been up 31.8.
Yep.
So for those who don't understand, the NASDAQ actually comprises part of the S&P 500, right?
Yep.
So a fair chunk of that gain in the S&P 500 has come from the NASDAQ or the
Yep.
Magnificent Seven. And you think about what, Australia, where our market leads from, resource-rich and banking sector, haven't had that influence of AI, and perhaps we don't have too many businesses in there that are at the forefront of AI at this point in time, and it speaks heavily to portfolio returns over the last 12 months.
Yeah, absolutely. And I think it's just there's one of those aspects then about being diversified too, like not trying. We've got lots of, I guess, clients who do come in and want to be sort of ASX heavy because they know it. This sort of, I guess, piece is difficult to comprehend sometimes, and wanting to, maybe not be exposed to it for moral or otherwise reasons, or just being scared of the fact that it's considered sort of just fugazi, I suppose. Yeah, it's just, it comes back to having a diversified, disciplined approach. So these things are always happening. There's always, whether it's AI now, it's going to be, it was something else 5 years ago, it's going to be something else in 5 years' time. It's being exposed to that across the journey.
Yeah, and I think I'm very pleased for our portfolios. We've had market weight to
Absolutely
S&P 500,
Yep.
and particularly in the diversification piece that you talk about, I think that's so appropriate because we have so many people that come to us who, for not maybe I was going to use the word bias, but maybe it's not a bias. It's just formed by the way Australians are wired in that we understand the brands of Australia.
Correct.
So portfolios historically have been anchored to our big blue chip stocks here in Australia, but I know in our lifestyle models we've blended it to a point where we have a overweight position, or a higher weighting rather, to US and European equities at the expense of Australia. But the blending of that doesn't dilute things like franking credits.
Correct.
We don't miss out on any diversification. So that sort of getting that blend is actually quite pertinent in times like now. And when you see return disparity as great as it has been, I'm very pleased that that sort of analysis continually happens on portfolios to make sure that we don't anchor back to what we know and understand historically, because it can have a bearing on portfolio returns.
Yeah, absolutely. Yep. And I guess the natural thing here is to say, well, this is what's happened. What's ahead, and nobody knows. So it's really just around, we're always coming back here every month talking about, this is where things are at in a backward looking context. Nobody has a crystal ball. So it's just about trying to create or increase your probability of success in a forward looking, of looking through the windscreen, I suppose.
Well, I think it's a good segue into kind of where AI has been masking a little bit of the Iran conflict and the volatility comes from that. This chart here about Australian focus, particularly, I think there's a number in here which I think is worth picking up and sort of picking apart a bit further about business confidence. And you sort of touched on it before, Chris, in regards to interest rates going up and that consumer confidence. We're now seeing oil prices, petrol prices are higher, groceries are higher once again, interest rates have gone up. So business confidence, I think this is an interesting indicator, because where does it take us when business confidence goes down? This is something that the Reserve Bank needs to manage carefully, I guess. Yeah,
well, it does. Well, it's just going to mean businesses out there are going to spend less. I look at business confidence, and for those who maybe hear that term and not too sure what it means, but it's basically the same as what it would be for a household. That if you're feeling less confident in what's going on in the world, your natural human reaction is to contract and say, well, I want to protect what I have. And the same things happen in businesses. Is like, well, am I going to hire that staff, or am I going to implement that piece of technology, or am I going to spend that money on capital expenditure to buy the building or build the machines? Or you're less likely to spend that money, which means then your, I guess, footprint or capacity for expansion and growth is smaller.
And I think it speaks exactly. Look, we think that at a micro level in our business, right? When you see
correct.
those things. So, I mean, when you think about interest rates being high and the cost of capital higher, and even the uncertainty of where the rates land, and I thought it was interesting yesterday, actually, even watching the market's response to a rate rise. The market was actually positive to a rate rise yesterday because the phrasing moved from, well, we've got this worry now to we feel as though we're in a restrictive phase, which essentially, as soon as they use the word restrictive, means that we're getting close to this is the ceiling on rates, which I'll be fascinated to see where business confidence goes back to once there is a known on what the cost of capital will be. Because I always feel as though when businesses can, calculate the cost of an investment decision,
Correct.
they will make that decision, or they may not if it's too high.
Correct.
But at the moment, we're seeing this significant decline in business confidence in really the space of a month, because all the factors that we saw back in 22, 23 have re-emerged, right?
Yeah, and it's people just want to make sure that they continue to be profitable and sort of look after themselves. So I absolutely get it. And again, the way I think about this though is that you can't be then looking at the business confidence number and then in a rear view aspect and then be making a wholesale decision about what you do with your portfolio, because especially these confidence figures, they're highly volatile and can change quite quickly, as we've experienced over the last month. It's just about understanding that that's the maybe psyche of the business aspect of the world and of Australia, and then potentially the consumer as well. Then it's about what do you do with that information? What decisions do you then make with that information? And in terms of, I guess, how we approach portfolios and the decisions we make with clients, I don't think it necessarily changes much for us.
I'm smiling, mate, because I feel as though we're the most boring investors of all time, because I might find a slide here that talks a little bit to that, because if you think about our approach to investing, we're anchored to evidence, aren't we? We're always anchored to evidence, and I always feel a bit awkward or nervous about making a statement as such as, history has shown volatility exists, so therefore we will be volatile and be okay again in the future, because I never want to downplay the significance of the emotional reaction in the moment when markets underperform or we hit these business confidence numbers that look poor, because it's not dismissive of the emotion.
Correct.
But I guess when we put back on our rational brain, we do come back to a spot, I feel, where you can process what's happening in the context of your portfolio decisions.
Yep. Yeah, that's I don't know that I could put that any better, mate. I think that's perfect.
Well, I know we're talking for benefit of everyone. Chris and I were talking about this before today, but there's a good slide here about psychology of investing through conflict. And, the numbers on the screen that you'll see are quite interesting in terms of sort of historical conflicts, what's happened in the markets and how quickly it's responded. And I think the Iran conflict has been fascinating. It's 1 month to recover from -8.
Yeah, it's I think that's the thing that most astounded me about this is it's just to come back in terms of, what we were expecting. A month is not what I was expecting. Like, I was thinking 2 or 3 months, and you can see on the chart, if you've got the chart in front of you, on the right-hand side there, we've got Pearl Harbor, the Cuban Missile Crisis, September 11 attacks, the Iraq invasion, Russia. They're all sort of somewhere between 6 to 12 months. It's a month is very rapid.
Yeah, and look, it's probably worth noting, we might keep this slide here for the next month or two.
Yep.
Because it's not over yet, so that's probably the other part of note. But I think this is where I find this conflict or this market response is probably a little different to the past, because we're just talking about the AI influence on, and the AI businesses initially had a hit when the conflict started, but they've just
since then.
Gone up since then. So that's dragging the market up with it a little bit. So I feel like that's masked a little bit when you see, business confidence come down. But above all else, I think what we take out of that information is that holding our nerve through periods of difficulty or conflict and having a sound asset allocation and portfolio matters enormously.
It does.
And I know I always say this, is that I'd be very worried if I was an investor and didn't have a plan for conflict.
Correct.
But if I'm an investor and I've got a plan for volatility in my portfolio, I always feel, even as an advisor advising people, I always feel as though when you've got a plan for something, you can work through it because you've planned for the worst and you hope for the best, essentially, right?
Absolutely. And one of the aspects too that I take great comfort in is when we go through these periods is there've been designed particularly to behave a certain way during all market events because of the exposures that we have deliberately wanted to have in the portfolios. And every time something happens, the portfolios behave exactly the way that we would expect them to. And one of the tests that I'm like forever looking at is, okay, X has happened. What has then subsequently happened in the portfolios? And is it different from what we had expected? That's almost like a very easy litmus test. And having, the portfolios of like almost 8 years now, since we kicked them off, is there hasn't been a period during any of that where they haven't behaved the way they were intentionally designed. And I don't think, I hope that never changes, because it means, to your point, that it's been planned for.
Yeah, and I think that's a great shout out. I haven't thought about it through that context, but it's exactly right. And I always think about the overlay there, and particularly for clients that are in drawdown phase. The idea
absolutely.
that
Yep.
Your retirement outcome is dependent on things you can't control.
Yep.
You can't help but always have a little bit of a niggle in your stomach about that as a thought. But to your point there, I think that's a very great way to surmise it, is that they behave how we expect, and then we always overlay a degree of protection or safety as our core tenet to a portfolio to ensure that we can work through these moments of unexpected, geopolitical issues that then result in the portfolios behaving in a way which, again, history shows that they, being market weight too, always makes it interesting from a more known result, I guess.
Yeah, well, and that's the aspect too. Is like, it's not that these events. Sometimes I say the word it doesn't matter, because it does matter. But when, especially in drawdown phase for retiree clients, less so than accumulation clients, knowing that we've expected these things, they're planned for, the portfolios are behaving the way we expected it to, but even if it continues to hold, say through a GFC scenario or worse, like that, again, not that it doesn't matter, because it does matter, but it's not going to have a material impact on your life outcomes as a result of that market event. So it's really about the portfolios being properly structured for how you wish to exist on a day-to-day basis, because ultimately that's why people are investing, and that's why they're here. It's not to, I don't exist to see my portfolio return 10%. It's got nothing to do with it.
Yep. Yeah, it's an outcome, right?
Yeah,
like a real life outcome.
Yep.
And I think an extension there, Chris, is just around, and again, I don't say this dismissively and stay the course, because it's a natural human behaviour to worry that their outcome is not going to be achieved when you get these moments of uncertainty.
Yep.
But I just thought I'd pick up on the extension of diversification, which you spoke about beautifully there in regards to the portfolios and how they behave. The rebalancing side of the portfolio too is a very strong discipline that happens in portfolios that helps enormously in times like today. So the way I always think about this is that there's things that we can control and there's things that we can't control. And, as you spoke about before, the things that we can't control, the portfolios, they behave in a way which we expect them to behave when things that we can't control occur.
Yep.
But through those points in time where we can't control something, rebalancing the portfolio, i.e. making sure that our asset allocation, when it deviates through market movements, comes back to the exact asset allocation that we want, it really helps with smoothing returns over a long period of time. And I often think it's one of those points that, I know I can get a bit lazy on it sometimes and don't talk about it with clients enough, because it happens so routinely in our mind, and it's just a normal process.
Correct.
But I'm always reminded of it, how important it is now. Like, for example, using that chart before about AI, Australia, suffers, US rally, trimming a little bit of the US and repurchasing Australia just maintains that asset allocation exactly where we want it to be, so that the outcomes that you talk about before give us the greatest probability of success.
Yeah, well, that's I love that. The probability, increase your probability of success is what we're doing at multiple levels. Like, there might be 10 different levels of those where you're trying to incrementally increase your probability of success. You add all those up, it makes a big difference. And you're right. I think we probably don't talk about it enough, because it's like it feels a bit sort of mundane and boring in terms of this is the discipline and the transactions that we run, and like it's not very interesting but these are the things that cumulatively make a huge impact over time. So yeah, I think it's a really good shout out.
So, mate, look, I think in sort of wrapping up the thematic of today, I feel as though we're looking and very conscious about what's happening in Iran. We watch. Well, I know I wake up every morning, look at the fin to see what's happened in the US overnight, just to make sure that we're across it. But I feel as though I think the most important thing here is to, the phrase of keeping perspective or keeping our sort of eye on the prize longer term, and being patient. And I know, I think we're very lucky actually, Chris, for what it's worth. We just, for context, I haven't had a single call through this conflict from an investor who's worried about their portfolio, which I feel as though is a great reflection on,
I agree.
how people perceive the information we share. So I feel like we're talking to the, converter with this sort of phrase, if you will. But I think maintaining our patience is the message we're going to continually talk about, right?
But I also think reminding the message continually is really important, because as a species, I don't think we're very good at remembering those lessons. The recency bias is quite strong. So I think it's really important to continue that message to make sure that you don't end up making an emotionally based decision, because, as you know, when those decisions happen, they're usually incredibly value destructive and are very difficult to recover the losses from those things. So it may feel like we're banging the drum and like going things over and over and over again, but I just think about how important it is for that message to continually be heard by people. Like, even if it stops like a single person making that, that emotional reaction and blowing up their financial world as a result, I think it's worth it.
It's so fascinating, like blowing things up. Like it's you feel good in the moment, right? People have that moment where they've run for the high ground, they feel safe in that very moment, and the emotional response quickly moves from safety to regret.
Correct.
And then almost anxiety, because you're missing out when markets.
Well, absolutely.
1 month ago, that was where we could have been at the high ground. 1 month later, markets recover. Month later, we could be back to where we were, -8 for the month of May. Who knows, right? But it's like that moment, that emotional response from us it's a hard emotion to moderate.
Well, it's actually, you just reminded me, I was talking to Cameron during the week, and I think he pulled out a stat from from Australian Super during the last month. Not 40% of members, not 40% of like balance amount, but like, let's say Australian Super has 100,000 members, so that would be 40,000 members went to cash.
Is that right?
Yep.
Wow.
So
that's value destructing right there.
Exactly. And then a month later, we're back. Yeah. So you've locked in you might not have sold at the bottom, but there will be some who did, who are now 16%.
Yeah.
Because they went 8 and sold, and
that's
and then state. 8 back up. On a $1 million portfolio, that's $160,000 inside a month.
Yeah, that's life
that
changing.
You don't recover.
Yeah.
So. I think it's just important to remember that, even though for some people they might get to this section every month and think, oh, they're talking about that again. But it is so important.
Fact. Yeah.
Yep.
Well, let's wrap it there. Let's see where May takes us. But as always, if people got questions, we're here to help, right?
Yep,
so give
exactly.
us a call.
Please reach out.
Let's work through questions, and let's remind ourselves of how we planned in portfolios.
Yep.
And we're confident that we can always work our way through whatever comes our way.
Yep. Exactly. All right. Thanks, Shane.
Okay. Thanks, Chris. Bye for now.
Bye.